The IMF and World Bank spring meetings ran from April 13th to 18th in Washington, D.C., and Africa was not on the margins of the conversation. Africa was the alarm in the room. Here is what was said, what was agreed, and what it means. The IMF's Africa Department Director, Abebe Selassie, opened his press briefing on April 16th with a line that said everything. Sub-Saharan Africa entered 2026 with the strongest economic momentum it had seen in a decade. And then came the war. In 2025, the region grew at 4.5%, the fastest pace in over a decade, driven by real domestic policy reforms in countries like Ethiopia and Nigeria. That momentum is now being dismantled by the Middle East conflict and the disruption of the Strait of Hormuz. The IMF has revised Africa's 2026 growth forecast down to 4.3%. Median inflation is projected to rise to 5% by year-end. Fertilizer prices, critical for a continent that feeds itself from the soil, have already doubled in some markets, jumping from $400 to $800 per unit. IMF Managing Director Kristalina Georgieva was direct. The IMF has a map on her office wall showing which countries are most vulnerable. The majority of Sub-Saharan Africa countries are in the quadrant of vulnerability, she said. She announced that near-term demand for IMF financial support is expected to range between $20 and $50 billion globally, with a number of those programs in Sub-Saharan Africa. Her message to African finance ministers: do not hesitate, move fast. Critically, when Georgieva met with the African Consultative Group, ministers and central bank governors, they did not ask for money. They asked for policy advice and support to develop local currency markets. That is the posture of a continent that knows its long-term answer is not dependency. That deserves recognition. On April 13th, IMF economists presented a chapter that carried one of the most consequential titles heard at these meetings. Aid cuts in Sub-Saharan Africa, this time is different. They meant it. Bilateral foreign aid to the region fell by 16 to 28% in 2025 alone. Further reductions are projected. And this time, the multilateral organizations that might have filled the gap, the World Bank, the IMF itself, are also under financial strain. The Center for Global Development put the stakes plainly. In 2025, 4 out of 5 African governments spent more on debt service than on health or education. The World Bank's Africa Economic Update echoed the same alarm. Public capital investment across Sub-Saharan Africa remains 20% below 2014 levels, and external debt service as a share of government revenue has doubled over 8 years to 18%. The World Bank's president, Ajay Banga, signaled up to $25 billion in rapid financing. But analysts warned that concessional finance envelopes are tightly constrained and that no amount of emergency lending changes the structural reality. A financing architecture built in 1944 is failing the continent it was never designed to serve. This week was different from previous spring meetings in one important way. African institutions convened their own space in Washington. On April 15th, the African Development Bank, African Union Commission, UN Economic Commission for Africa, and UNDP jointly released a policy paper documenting that 80% of Africa's oil imports and 50% of its refined petroleum come from the Middle East region, and that 31 African countries were already experiencing currency depreciation. Their call was clear: accelerate the AFCFTA, diversify energy, and build the African Financial Stability Mechanism, because Africa remains the only major region in the world without one. The African Union also hosted a high-level dialogue on Africa-US private sector partnerships, featuring the AFCFTA Secretary General and the AUC Deputy Chairperson. And the Nkafu Policy Institute convened a parallel Africa-led summit, ensuring that African voices were not just responding to the agenda set by others, but helping to set it. The IMF and World Bank both stepped up this week in data, in rhetoric, and in preliminary financing commitments. That matters. But the Pan-African reading of these meetings is this: the global financial system is not structured to absorb Africa's crises equitably. Credit ratings overcharge African borrowers. Debt restructuring is slow. Aid is structural, not charitable. And its withdrawal has structural consequences. The answers are African-owned: the AFCFTA, the African Financial Stability Mechanism, domestic resource mobilization, and regional energy integration. Every institution in Washington this week, including the IMF and World Bank, pointed in that direction. The question is whether the political will on both sides of the table matches the urgency of the moment.